Right. Hello, welcome everyone, and thank you for joining our TAP Property Q&A webinar. I am Dani Netzer, Investment Director at TAP Property, and today I'll be answering all your questions about TAP Property and about our recent property deal that we've just gone live with, which is Travelodge Chigwell. Now, since we've launched this property, we've had loads of interest and many questions, which we will be answering today. So please feel free to post any questions you might have below in the comment section. And time permitting, we will be addressing all of them either at the end or as you go. Right. Just so you know, we will be posting a copy of this presentation in the link below, so have a look. And as we'll mention at the end, if you've got any questions, please post them below. Right, before we go into the Q&A, I just a little bit introduction about TAP Property. Now, TAP Property is a fractional ownership investment product focused on capital appreciation and income. Now, TAP Property allows UK investors to invest from as little as £1,000. Just for example, as you can see on your screen, this hotel, this lovely Travelodge, which we'll be discussing soon. Before, obviously, TAP Property came around, the only way one could invest in such a property would be to get 20% or 30% deposit and then borrow the rest to be able to purchase this property. What TAP Property allows you to do is to own this particular property for as little as £1,000 without any debt. And there are many advantages to it. First of all, you can diversify across multiple properties, so you can stick as little as £1,000 on various assets. There are no management or acquisition hassle. Everything is dealt by us here at TAB. We deal all the way dealing with the solicitors, the acquisition, with the agents, and then bringing it through the management process, and then all the way to the eventual sale. We regularly report to our investors, so we tell them about the performance of our tenants, any updates, if there's any appreciation to the assets that we've been able to improve. We notify and we let all the investors know about that. We also have an escrow account where we put any investors' funds on reserve, and these are funds that utilize. We'll discuss about this point a bit later on. And then there's no debt, as we mentioned before. We don't need to go out for a mortgage, and you can own this asset without any debt. Right, so let's discuss this particular Travelodge. As you can see, it's already live on the platform, as I mentioned. So this is a 34-bed hotel located inside of Chigwell, up the road from the underground station. Now, Chigwell is a residential area. It's very affluent. It's in a suburban environment. It's a beautiful green area. It's near many parks. Really lovely part of town. It's just northeast of London. It's a suburb of London. What's with this hotel? There's a tenant in place, which is Travelodge Limited. There's a lease in place, an FRI lease, which means a full repair and insurance, meaning the tenant is responsible to maintain the property and the cost of insurance. The lease is in place until 2035. In 2035, we've got an option to extend the lease at the landlord on behalf of our investors till 2041. Now, this is quite a positive aspect of it, because that means you've got secured income for the next 17 and a half years against the property. Right. Another item is the rent is being reviewed every 5 years with the tenant, and it's directly linked to RPI, which is the retail price index. It's upwards only, and it's uncapped, which for the benefit of the investors, that's a hedge against inflation, because as inflation go up, obviously when the next rent review will come around, the interest will increase as well. Now, point 2, as you can see here, it talks about the virtual freehold aspect. So one of the questions we ask is that the property is being held on leasehold. So it's talking about this is virtual freeholds. In other words, a lot of questions we asked, this is not being held on freehold, but this is a 999 lease from 2010. We are paying the freeholder peppercorn rent, which is a small rent of £10. It's for all intents and purposes equivalent to a freehold. There are no restrictions on our lease. We can use the building for alternative use. We can develop it, and we've got full access to it. Now, the point number 3 that's mentioned on the slides is price per square foot. If we considered the full amount of the investment, including stamp duty or all the costs associated, it averaged around £327 a foot. We looked quite closely at comparables in the area, and a conservative estimate of sold prices in the last 12 months in the area has been £510 a foot, which is a good indication that we're buying the building quite well on a capital value basis. We're discussing about that advantage. This is a commercial asset, so it's eligible for SIP and SAS investments. Point 5 relates to how well we're buying also from an investment point of view. We've looked at comparable evidence of travel lodges and other hotels that have traded in the last 12 months. And we've calculated that we value this building based on the rest of the market at £4,225,000. As I'll mention shortly, we're actually all in. The investors will be for 3.68 million. So the purchase, we're getting quite a discount on day one. We'll touch on this a bit later. There's potential also. I mean, there's always any upsides there. Any beneficial upside will be from the building, any upgrades or any improvement in the lease. Obviously, it will be to the benefit of our investors. Right. So, I mean, this was a brief summary. I just wanted to go now through the various questions. These are the headline questions being asked in various formats. We just summarized them for you and just went through it. So if you go onto our page, and if you haven't done so, please do go have a look, because there's bags of information on the actual page of the property on our platform. You will see these headline figures. You'll see total investment amount, you'll see the net yield, projected capital growth, and overall projected return. So we've been asked from many investors, what's the difference between these two figures? And let me just briefly explain to you. So as I mentioned before, this is the total investment amount. This includes the full, the purchase and all costs, as we're going to see a little bit further on. The net yield is the net annual return investor will be receiving as a percentage of the amount invested. Now, this is an annual net yield, and it will be distributed on a monthly basis to our investors. And that's a return on whatever you're putting into this property. There's a projected capital growth, which again, we're going to go into a bit more details, which is the annual capital growth, and which this amount is only realized upon the exit of the investment. So whenever we sell the investment, this is when you're going to be realizing that amount. So the overall projected return is a combination of these two figures, which is 7.62% yield plus 2.5% projected capital growth. This is paid monthly, and this is realized on exit. Now, how do we calculate the net yield? Right. So let me just walk you through the figures. These two tables represent the two figures that are going to be key to calculate what the net yield is going to be. So we keep mentioning this 3.68 figure, and this is how we get to it. So we have the 3.396400 purchase price. We've got purchase cost of £205,000. Purchase costs include SDLT, which is a stamp tax, legal fees, agent fees, or any other costs related, any consultants that need to be paid for the purchase of this property. Then there's a tab listing fee. This is a fee that tab charges its investor to introduce the deal. And as I mentioned before, there's the reserve fund. Now, the reserve fund, this is money held on account for the investor for any unusual costs. Now, as this tenancy we mentioned before is FRI, full repair insurance, ongoing costs are predicted to be minimal. However, it is always good practice to have funds in reserve for any unforeseen occasion. Now, this is on day one of the purchase. The net income, so we've got the gross rent per annum. This is what Travelodge pays as the tenant on an annual basis. We keep reserve fund. The reserve fund is constantly being topped up to make sure there's enough in there for any unforeseen. Tap management, this is for us to look after, to liaise with the tenants, collect the rent, and improve the assets as much as possible. If we subtract these two figures from the gross rent, we get to the net income, which is £280,000 per annum. Now, all these calculations, if you go to our page, you'll be able to find all this information. There's various attachments. I encourage you to go see it. If we take the net income per annum, which is £280,000 circa, and you divide it by the total investment amount, you get to the 7.62%, which is the yearly income. Right, another question we constantly being asked, is Travelodge a good tenant, and is the net income guaranteed? In a way, these two questions actually are connected, because the net income is guaranteed by Travelodge. Travelodge have a lease in place. They are contracted to have to pay the rent on a regular basis, and therefore the net income is guaranteed is very much dependent on the strength of Travelodge, and therefore we looked quite closely into Travelodge and see how strong they are as a covenant. So Travelodge was founded in 1985. Second largest hotel brand in the UK with 46,000 bedrooms across the UK. We've had a look quite closely at their accounts. So most recently, they've released the account in August for the first half of the year of 2023. And the total revenue has been up by 22.4% compared to the same period last year, and EBITDA of £104 million, which is, again, it's up from 70.6 million the previous year. Now, we've looked at both the 2022 and, as I mentioned just now, half one of 2023 figures, which shows a very strong bounce back, and they came back much stronger than pre-COVID 2019. If you go onto our page, in the investment memorandum section, we've got a very detailed rundown of all the figures, comparing them also to before 2019, as well as we have the link to the full account. So, feel free to have a look at the figures yourself. The next question is, we've previously mentioned projected capital growth. So how do we calculate the projected capital growth? So I just want to premise this projected capital growth makes no assumptions about potential increase in rent, RPIs, market improvement, yield contraction. This is purely based on a discount achieved on purchase on day one. And the way we've calculated this, as previously mentioned, we looked at comparable trades. We took a conservative figure, assumed that, and we calculated that the value of the asset is 4.225. If we were to sell this asset, there will be associated sales cost of 2%, which means that net realization on exit, should we sell the asset, will be £4.140,500, which means you'll have a net profit post sales of 460,000. Now, this figure is derived by subtracting 4,140 minus the total investment of 3,680, which means this is your net realization, which is equivalent of 12.52% of the 3,680, which means that if you were to sell the property today, that's what you should be making on the sale of the asset. If we spread this profit over a 5-year period, it's 2.5%. It's important to note this figure is not compounded, and this is just spreading the 12.5% profit over the 5 years. And again, I just want to reiterate, this is without considering any movement in the market, any improvement in the market, any improvements in rents, any contractions of yield. This is purely based on day one, what the worth of the property is today. Now, obviously, should there be any improvements in the market, any improvements in the rent, and the value of the property will go up, the benefit of that improvement will go, obviously, to the investors. Now, obviously, another very, very popular question is we keep being asked, what happens in the 5 years? We mentioned this investment is a 5-year cycle investment. What happens in the end? And then what happens if I need to take my money out early? So just as the headline answer to this question is, after 5 years, the plan is to sell the property on the open market. We would realize by that time the income and the capital appreciation and sell it on the open market. However, should a person want to exit within that period, we have allowed investors to trade with one another. So if somebody wants to sell their particular investment from the property to the other investors, they've got capability of selling it instantly, really offline, really. So we would be able to find another investors to take over your investment. And from Q1 of 2024, we'll be launching an online trading platform where you'll be able to list your investment on the platform, and then you'll have other investors looking to buy the investment, which actually leads us to option 2 as well, whereby at the end of 5 years, obviously we would like to give, obviously we say we will sell it on the open market. However, we would like to give the option to our investors in 5 years to be able to buy the asset from the existing investors, which means we'll be able to leverage on our trading platform to be able to exit as an additional option to exit from the investment and try and sell it on to other investors. And obviously, as I mentioned before, open market sale, that's always something that we're going to target, is try and sell the property on the open market. I'll check. I don't know if there's any other questions, but what I've done, we've had, before you went live, between yesterday, the last couple of days, a few questions that actually people came to us. Just before I get to these questions, I just want to highlight, so obviously Karen is head of investor relations. This is myself. If you've got any questions, our emails can be found here. Please do contact us with any questions. Alternatively, you can go directly on tabhq.com and find all the information on there. Just let me go through a few of the questions that we've been asked in the last 24 hours. So question number 1, how do you know Travelodge is a good tenant? So this is something we've covered. This is something we've covered before. Travelodge, we look through the accounts, we look how historically they've done, and the projections, the results that have come out. And obviously they've recovered post-COVID. They had a very, very good recovery since then. Is capital value you are buying sensible? So again, this is a very good question, because obviously from an investment point of view, you always want to make sure that you get good return for your buck. However, you want to make sure that the brick and mortar that you're buying good value as an asset, generally independent of whether the tenant is there or the tenant is good or not. And obviously, as we mentioned before, we've checked it on a per square foot basis compared to other properties that have sold in the area in the last 12 months. The next question we've been asked, what if there is an unexpected cost? Will we need to put more money in it? So if, let's say in 3-4 months, if there's any, we need to get a consultant, maybe to potentially look at planning to go upwards. Is there any cost associated, additional cost to put money in? So as previously mentioned, there is a reserve fund in place whereby we will actually allocate money for occasions like that. And the whole idea of the reserve funds is that we don't have to go back to investors to raise more money, but rather that fund is there actually to cover any unassociated costs. When do I receive my first payment? We pay monthly to our investors. So from the rental that we collect quarterly, and the rent is paid monthly to our investors, and that's on the 15th of every month. We expect the first payment to be on the 15th of February. Right. Another question we've been asked, can I increase my investment throughout the project? So that's an excellent question. So I think there's 2 points really to answer that question. Point number 1, as you mentioned on the trading platforms, the idea is going to be if you will have investors who are going to want to exit their investment, you'll have an opportunity throughout the cycle of the investment to trade, more investments into the property. And definitely that's something that's going to be open, and investors will be aware as soon as somebody decided to sell it on the platform. The other thing is, overall picture for Tap Property, this is the first large investment. We're going to have many, and the idea is to be able to trade and to reinvest into other properties, reinvest the profits into other properties. And the idea is, you can put more money into the investment, as I mentioned, by the trading, but there'll be many opportunities coming onto the platform. One more question: is the capital growth limited to 2.5%? So I think here, as I mentioned before, 2.5% is an estimate which we've taken into account no other growth except for the discount that we've taken on day one. However, any growth based on increasing rent or the market improving or any planning uplift, any improvements to the property, either to the physical or to the investment angle of it, will be purely to the benefit of the investors, which means you've got this massive upside potential for this particular investment. I'm just trying to see if there's any other questions at the moment. Perfect. Just to let you know, if you've got any questions, you look at our website. Again, go on our website. But thank you all for joining us today. Appreciate if you've got any questions, please get in touch with us, and we'll see you on the next webinar. Thank you.